Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of company reports without putting you to sleep. Today we are diving deep into the Oakhurst Strategic Defined Risk Fund's latest shareholder report. And let me tell you, this one has a few surprises tucked away. So, what is the big picture in this report from October 2025? Well, it's a snapshot of how this fund was doing between May and October of 2025, giving us a look at their investments, their costs, and how things stacked up financially. Let's cut to the chase because nobody likes a boring financial report. When we look at the costs for a hypothetical investment of $10,000 over the last 6 months, we see that the institutional class had costs of $83. Now, that might sound small, but it translates to about 1.53% of that $10,000 investment. Keep that percentage in mind because it's what really matters when comparing expenses. Now, for some key numbers as of the 31st of October 2025, the fund had total net assets of a substantial $74,338,833. That is a lot of money. They were holding 22 different investments, and their net advisory fee, which is what they pay their investment managers, was $359,097. Their portfolio turnover rate was a flat 0%. This means they weren't actively buying or selling a lot of their holdings during this period. Think of it as a very stable, hands-off approach to managing the fund's assets. So, where was all that money going? The top holding by a significant margin was the First American Government Obligations Fund, making up a massive 51.2% of the net assets. This indicates a heavy focus on very safe government-backed investments, which makes sense given the fund's goal of limiting short-term risk. They had the SPDR S&P 500 ETF Trust at 8.4%, and the Invesco BulletShares 2025 Corporate Bond ETF at 2.7%. When we break down the security types, we see that short-term investments accounted for over half at 51.2%, again pointing to that conservative strategy. Purchased options made up 20.7%. Exchange-traded funds were at 11.1%, and surprisingly, written options were at a negative 2.1%. This negative percentage for written options means the value of those options decreased, which is usually good for the fund since they sold them. And finally, cash and other assets made up the remaining 19.1%. Looking deeper into the schedule of investments, we see the fund's strategy more clearly. Their biggest play is in the First American Government Obligations Fund, essentially parking a huge chunk of money in very secure, short-term government debt. This is a classic move for funds aiming to preserve capital and reduce volatility. They also hold the SPDR S&P 500 ETF Trust, a very common way to get broad exposure to the US stock market. The fact that they are holding significant amounts in purchased options and managing written options really shows they are actively trying to manage risk and potentially generate income from premiums. Now let's talk about those options specifically. The schedule of written options shows they sold quite a few call and put options, primarily on the SPDR S&P 500 ETF Trust. When a fund writes options, they receive money up front called a premium. This is income for the fund, however, it also comes with an obligation. If the market moves against them, they might have to sell stocks at a lower price or buy stocks at a higher price than the current market. The reported value of these written options, a negative $1,562,364, indicates that these sold options have decreased in value, meaning the fund has likely benefited from this portion of their strategy during this period. It's an interesting way to try and generate returns while supposedly limiting risk. Moving on to the statement of assets and liabilities, as of the 31st of October 2025, the fund had total assets of $76,007,472. Their investments alone were valued at over $61 million. On the liability side, they had written option contracts valued at $1,562,364, which aligns with the schedule of written options. The net assets of the fund, which is basically the total value minus liabilities, stood at $74,338,833. The net asset value per S-hair for the institutional class was $13.05. The statement of operations shows us how the fund performed in terms of income and expenses. They earned $1,062,267 in investment income, mostly from dividends and interest. Their total expenses before any reimbursements were $544,603. After a small expense recoupment by the advisor, their net expenses were $546,675. This resulted in a net investment income of $515,592. But the real story here is the realized and change in unrealized gains and losses, which added a whopping $8,940,724 to their net assets. This significant gain comes from both investments increasing in value and from the options activity. The statements of changes in net assets show the movement of money into and out of the fund. For the period ending the 31st of October 2025, the fund saw a net increase in net assets of $7,700,577, largely driven by that positive operational performance. Looking back at the year ended the 30th of April 2025, they had a net decrease in net assets of over $13 million, primarily due to significant distributions to shareholders. It seems they paid out a lot of their earnings last year. Now, let's look at the financial highlights for the institutional class. The total return for the period ended the 31st of October 2025 was a strong 14.37%. That is a pretty good return, especially considering the fund's focus on risk management. When we compare this to previous years, we see some big swings. For instance, in 2021, they had a return of 19.02%. But then in 2022, they actually lost 2.70%. This highlights the inherent volatility even in funds that aim to limit risk. The expense ratio, which is what it costs to run the fund, before any expense reimbursements was 1.53% for this period. Diving into the footnotes, we get more context. The fund's main objective is to seek capital appreciation while limiting short-term risk, which really explains that heavy investment in government obligations. They are also using option strategies to try and boost returns when markets are up and cushion losses when they are down. This is a complex strategy that requires careful management. Under the significant accounting policies, they detail how they value their investments, which is pretty standard for publicly traded securities. But what's interesting is their use of derivatives, particularly options. They use them to manage volatility, and in some cases to generate income from premiums. It's important to remember that while options can limit losses, they also limit potential gains. There is also a detailed section on offsetting assets and liabilities, which is related to their derivative contracts. Basically, it is about how they manage the risk from these options trades. The use of options means they're exposed to market risks, and these arrangements help define how they handle those risks, especially with their prime broker Interactive Brokers. The section on related party transactions is crucial. Lido Advisors LLC is the investment advisor, and they're entitled to an annual advisory fee of 1.00% of the fund's average daily net assets. Lido also has a commitment to limit the fund's total annual operating expenses. They did actually recoup some previously waived fees, which is a bit of a mixed bag. It means they are managing costs, but also taking back some money they had previously shouldered. This section is a big part of what makes these reports interesting. The Board of Trustees who oversee the fund met to decide whether to continue using Lido Advisors LLC as the investment advisor. They reviewed Lido's performance, fees, and services very closely. Interestingly, while the fund underperformed its benchmark index, the S&P 500 index, for long term periods, it actually outperformed its peer group median and average. This suggests Lido's strategy, while not tracking the broad market perfectly, is performing well compared to similar funds trying to achieve similar risk management goals. The board concluded that Lido's services and fees were reasonable, and they renewed the contract. They specifically noted that while the fund has underperformed the S&P 500, its performance is satisfactory given market conditions and its risk management objectives. So, what is my take on all of this? The Oakhurst Strategic Defined Risk Fund presents a very cautious and managed approach to investing. The heavy weighting in government obligations and short-term investments clearly shows a priority on capital preservation and minimizing volatility. The use of options is a sophisticated strategy designed to amplify returns in favorable markets while offering some downside protection. However, this complexity comes with a trade-off. The fund's performance won't mirror the broader market, and its returns might lag significantly during strong bull markets. The fact that they aim to limit risk means they are likely also limiting potential gains. The recent positive performance, particularly the strong total return of over 14%, is encouraging, especially given the gains from their option strategies. A key takeaway is the fund masters have a clear strategy to try and win in two ways. First, by having very safe investments, and second, by using options to try and make money in any market. It is a delicate balancing act, and it is important for investors to understand that this is not a typical index tracking fund. You are trusting the managers to correctly play the options market to add to your return. The fact that the Board of Trustees renewed Lido's contract is a vote of confidence, especially given the mixed performance against the benchmark, but solid performance against its peer group. This indicates that the managers are doing what they set out to do in terms of risk management, even if it means not capturing every single market upside. The significant distributions last year and the strong gains this period highlight the dynamic nature of this fund and its strategies. Alright, that is our deep dive into the Oakhurst Strategic Defined Risk Fund's latest report. What are your thoughts on this blend of conservative and complex strategies? Do you think it is a winning formula? Let me know in the comments below if you found this breakdown valuable. Please hit that like button and subscribe for more in-depth corporate analysis. And don't forget to join our Discord community, linked in the description for more real-time discussions. Thanks for watching Corporate Decoder, and we'll see you in the next video.